Many people believe that Warren Buffett is the greatest investor of all time, and every year after his annual Berkshire conference, there is a rush of inquiry into every word he says. This year, the focus was evidently on Berkshire's enormous cash pile and what it might mean for the overall economy. These developments suggest that Warren is hinting at the possibility of a major economic collapse in the United States, and that this buildup is intended to prepare for it. It stands to reason that when an investor hesitates to deploy their cash reserves, they believe the market is devoid of worthwhile opportunities. With 500 businesses listed in the S&P alone, there are questions about whether Warren Buffett sees the entire market as an inflated bubble. It's also unclear why he wasn't able to find enough qualified individuals. The chart that goes with it shows the war chest's record size. The allure of present cash yields is a common rationale given for this growth. It's important to understand that when Warren Buffett talks about his $189 billion cash position, what he really has is cash equivalents in the form of short-term U.S. Treasuries. This may sound complicated, but the main idea is that his holdings are producing a yield. The current 3-month U.S. Treasury offers roughly 5.4% returns, making it a very alluring guaranteed investment. Buffett, however, dispelled this myth during this year's conference, stressing that he would continue to maintain the same level of cash reserves, even if the yield was as low as 1%. When asked this question by Joe and Halen, Buffett stated his belief, saying, "You're sitting on $168 billion of cash, which you told us today is now more than $182 billion. His two questions are, 1. What is Buffett waiting for? And 2. Why not at least use some of it? Both of them are quite simple to respond to, in my opinion. We don't use it, and we don't use it at 5.4% right now, because, in my opinion, none of the people here at this table knows how to use it properly. However, if it was at 1%, we wouldn't use it. Don't tell the Federal Reserve that, but if he's not interested in yield and genuinely believes there is no worthwhile way to use the funds, it stands to reason that he thinks the market is extremely overpriced. If the market is overvalued, it will inevitably crash in order to become undervalued. In essence, many people interpret these actions to mean that Warren Buffett is waiting for a crash. Although he is reluctant to acknowledge it, it is evident that he anticipates difficulties. In 2001, Buffett even unveiled his own indicator to measure the U.S. equity market's overall valuation. This metric, which is now widely recognized as the Buffett indicator, compares the U.S. GDP to the total market capitalization of publicly traded companies in the U.S. In other words, it measures the economic output of the country relative to the total value of its publicly traded enterprises. When one component deviates significantly from the other, it becomes evident, and Buffett himself described it as likely the most accurate way to gauge valuations at any given time. The Buffett index is currently at 199%, indicating that the U.S. markets are overpriced by nearly 2 standard deviations above historical norms. Unlike other markets in the finance world, the market has seen significant downturns whenever this ratio has increased to such heights. Though they freely acknowledge they have no idea when a recession will come, Warren Buffett and Berkshire Hathaway's approach can be distilled into a simple theory. They are excellent at identifying when something is overpriced. Eventually, market forces will correct these imbalances, creating opportunities. Warren says something that truly puts everything into perspective. Even though he may not be able to predict when or where these corrections will occur, he also recognizes that the current situation is abnormal and will probably change quickly over time. According to Buffett, the reason why things aren't appealing is because there are certain things that can be changed. But it's not like he's on a hunger strike or anything. We'll see if they follow through on his statement at the end that there are ways in which they can change. As we all know, this means that stocks are significantly overpriced, and we don't even need to look at the Buffett indicator to see this. For instance, the 10-year Treasury yield, an indicator that has accurately predicted nearly every recession over the past 50 years, has been inverted for more than 630 days, breaking the record set in 1978. This is a classic sign that a recession may be approaching, as it occurs when short-term bonds yield more than longer-term bonds. One way to view of it is as a warning indication that investors anticipate difficulties in the economy in the near future and are therefore willing to accept lower returns on long-term investments. On the other hand, they believe that things will improve in the long run and are therefore willing to take higher returns fast. Currently, you can see that the 102 is still below zero, indicating that it is still inverted. This has always been a bad indication. There are currently no strong indications that a recession will occur anytime soon. Typically, a recession occurs when this line rises back above zero and ceases being inverted. However, given that we recently shattered the record for the longest period of time in inversion, it makes sense to believe that a recession may occur sooner rather than later. Since he is aware of how difficult it can be to predict when a recession will occur, many Berkshire investors know that Warren will never be outspoken about his bearish sentiment. However, most investors also know that you can read between the lines of his statements and recognize when he is bullish about the market, and this is one of those times. In fact, according to Bill Smead, Chief Investment Officer at Smead Capital Management, this is the most bearish warrant that he has ever been in which he provides his controversial analysis and is fully in charge of it. Now that we're talking about their massive cash pile minus $180 billion that is approaching $200 billion, let's get started. There is a discussion over whether shareholders would prefer that they make a large acquisition, pay a dividend, or buy back shares. They respond that they have no interest in the dividend and that it is okay for them to do so. Stocks, but you always have to consider Berkshire Hathaway. As I mentioned earlier, Warren Buffett is a really nice guy who has no intention of offending anyone. But if you look at what he's doing, he is as bearish as he has ever been. I was able to read between the lines at the meeting on Saturday. I was thinking to myself in the crowd, hey, big cash position trimmed his Apple position. That's not right. He's nibbling on something below the surface that they haven't announced yet. In essence, he is holding off on applying enormous sums of money at deep discounts to significant investments until the next 40% fall in the stock market to this company at its current size. So you just use the phrase, this is as bearish as it gets. You stated, I suppose, as I have always seen him should. Is it truly the correct description, or is it more likely that he feels the market is too expensive for him to enter significantly and use new capital stated differently? The call is not so much bearish as it is a denial of the notion that now is a good moment to invest. Bill Smead replies, I'm going to answer this in kind of an odd way, Tyler. You asked a great question. He changed his investing style in 1969, moving from being a quantitative Ben Graham value guy to more of a Charlie Munger qualitative guy. He stated in letters to partners 67, 68, and 69 that the quantitative ideas he had previously liked to purchase had been examined and recommended. And he remarked that the activities we would like to undertake have been picked over and over again this year and previous year. That is code for, we think the market is expensive. We're not in a rush. We're going to wait. And keep in mind that over the course of the last 10 to 15 years, he has made repeated comments about how, as Berkshire grows, its opportunities decrease. Therefore, in order to have significant opportunities for large deployments of that $200 billion, the entire market would need to encounter extremely challenging conditions. In other words, there are numerous indications that Warren may be concerned about an impending recession. Of course, this is all conjecture based on his actions, or rather, inaction in this case. The Berkshire cash pile has grown excessively, and it's evident from indicators like the Buffett indicator that stocks are indeed severely overvalued. Historically, however, the only thing that has made stocks valuable again has been an economic recession, and it can be argued from data like the 102 yield curve that we do have some concerning indications that we may be headed for trouble soon. In conclusion, Buffett's warning about a potential economic crash may seem bizarre at first glance, but upon closer examination, it reveals some crucial insights into the current state of the economy. His analogy of the time bomb highlights the risks associated with high levels of debt and overvaluation in financial markets. While it's easy to become complacent during times of economic prosperity, Buffett's words serve as a reminder that markets can turn volatile unexpectedly. Moreover, Buffett's Emphasis on the importance of staying rational and not succumbing to fear or greed is invaluable advice for investors. In times of uncertainty, it's crucial to stick to a well-thought-out investment strategy and avoid making impulsive decisions based on short-term fluctuations in the market. That being said, it's essential to note that Buffett is not predicting an imminent crash, but rather warning investors to be cautious and prepared for potential downturns. He remains optimistic about the long-term prospects of the economy and advises investors to focus on businesses with strong fundamentals and competitive advantages. As investors, it's essential to heed Buffett's advice and remain vigilant in monitoring market conditions and adjusting our portfolios accordingly. By staying informed and disciplined, we can navigate through turbulent times and emerge stronger on the other side. So if you found this video helpful, don't forget to give it a thumbs up, share it with your friends, and subscribe to our channel for more investing tutorials and market updates. Recall that the secret to effective investing is knowledge. We appreciate your time and will see you in the upcoming video.